Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
Welcome to the show, everyone. Today we're going to talk about 7 questions you should ask when searching for a trusted guide. Now, first and foremost, what is a trusted guide? A trusted guide, in our sense, is someone to help you with that retirement plan moving forward. Someone who can be trusted, which means they're going to be someone who can be a comprehensive retirement planner, not someone who just manages investments. This is going to be someone who is going to make sure they're going to provide a continual service to you and have a process proven to serve people just like you, people who are in or near retirement. And so that's what we're going to help you vet out. If that's you, if maybe you're looking for someone to serve you ongoing, we're going to give you in our eyes what we feel makes a really good retirement planning team so that you can have your hard-earned life savings value throughout your retirement so you can do what you want, right? We want to make sure you can enjoy what you've worked so hard for. So that is the goal of today. And we're going to really use a green light, red light approach here. And what that means is we're going to make sure that if they do this, we're going to tell you that's a green light. If they don't do this, that's probably a red light. You may want to think twice about either working with them or maybe they're not the best fit. So hopefully these questions will help you here. So the first question I want to get into here is, are you a fiduciary? That is something you should always ask anyone that you work with. And what we mean by that is, are they acting in your best interest? When they are building that retirement plan, do they have access to all the different types of vehicles out there to build that plan? Or do they only focus on investments, or do they only focus on mutual funds, or do they only focus on insurance products? You want to really get a good read and know, are they independent or are they not? If they're captive, in my mind, that may not be acting in the best interest for what you're looking for. And so we see a lot of companies out there, bigger firms, where maybe they only specialize in one area and they may still consider themselves a fiduciary, but are they truly acting in your best interest? They may be able to do so by law, but are they truly acting in your best interest? Because what is a fiduciary by law may not always be, the way to see if they're truly doing the best thing for you, in my mind. For example, when I first got into the industry, I was technically a fiduciary from the start, but when you work with a company who's maybe a little captive, are you truly able to offer what's best? I remember sitting in front of a client and they were looking for a long-term care insurance policy. And we only had 3 to 5 options to choose from. And they said, I want this company. And I said, sorry, I can't get you that company with the products that we have, that we can only offer so many solutions at this company. And so in my mind, I don't believe that I was acting as a true fiduciary at that point, because I was not being able to provide the best solution for their situation, because the company I was working for was captive. So just be aware of that. Again, captive firms are not the worst thing in the world, but do you want the best, or you just want something to get by, is ultimately what my decision of why I decided to go independent and start Peak Retirement Planning, is to give our clients that full freedom and flexibility to truly get what we feel is best for them and not have to be tied down to whatever we feel that is in the company's best interest. So that's a big one to me. Another big one we see out there is people just are insurance salespeople. This one, just to be honest, truly bothers me, that insurance salespeople can consider themselves a financial advisor, and they'll title themselves that and they'll act like they do that, but really they're just trying to sell an insurance product for a commission. And you've probably heard me talk about that before. It's not that insurance products are bad. It's just the fact that if you don't build a plan, what is the insurance product good for? And so you just want to be aware of that, just not being sold something you don't need, or just being convinced that you're working with someone who does planning who maybe doesn't. So if they say yes to the question of, are you a fiduciary, that's a good thing for the most part. If they say no, or maybe they don't answer it directly, or they're not willing to put it in writing, that's a red flag, and you might want to move on to that next person. There is ultimately something I would encourage you of. So that's question 1 there for you. Question 2 is, do you have limitations in the products or solutions you can offer me? So that's a question you should be asking there. And I'll say it again. Do you have limitations in the products or solutions you can offer me? I've really already answered this in the last question, and it comes across as, are they captive or are they independent? And so if they say, no, we are independent, we can offer whatever you want, we can sit on the same side of the table from you and offer what we feel is best, we'll give you recommendations and we'll work through them together, that's a big green light. I like that advisor. I think that they're going to do really well for your situation if that's what they're saying. If they say, yes, we are limited, or there really is no difference between being captive and independent, we offer the same solutions, that's probably a red flag. There's a big difference between being captive and independent in my mind, and so that would be something that you would want to explore further, is that question there. The next question, which is one that we see very often, is how do you do tax planning? What software do you use? Can you give me a copy of your analysis? Those are the questions you need to be asking when it comes to tax planning. Now, let's just walk through each of these questions. First one is, how do you do tax planning? The reason why we phrase this question as how do you do tax planning versus do you do tax planning? Because if you ask any advisor out there, do you do tax planning? Most of them will lie to you and tell you, yeah, we do. Yes, but what's been your results? I mean, we see people who have worked with their advisor for 30 or 40 years. They come see us and, they say their advisor does tax planning, but there's nothing to show for it. There's nothing in Roth. It's all in tax deferred. They've done no charitable planning. There's no tax loss harvesting in their capital gains. I mean, I could go on. And so understand, anyone can say that, but are they truly following through with it? And that's why we phrase the question that we would want you to ask someone is, how do you do tax planning? And then you'll be able to get an understanding of, do they really do it or not? Because if they don't have a process behind it, they're probably not doing it every day for their clients. And so what we would want to look at is, hey, what software are they using? How are they dictating how much you should Roth convert each year? How are they dictating if you should Roth convert each year? What are they doing to decide if you should contribute to a Roth IRA or traditional IRA? A 401k Roth or a traditional 401k? Those are the things you really want to look at. And that's that next question is, what software do you use? That's a really good one. Most advisors aren't really using software, so that would be a really easy one to comb in and out of because they wouldn't have an answer. And then if they do have an answer, you just need to make sure you do your due diligence to make sure that that is an actual tax planning software out there for advisors. So there's not a lot of them out there. So you just want to make sure you're getting that answer. And then the last one is, can you give me a copy of your analysis, right? If they're using a software, if they're doing tax planning, then they should be able to spit out a tax report or some type of analysis showing you what type of things could they do for you. And so those are the things that you want to look out there. And so the green light, the way we say it, is someone who shows you their software, provides a tax report, does an annual review of your tax return, making sure they look at it every year. And then they're going to discuss Social Security taxes, Medicare premiums, capital gains tax treatment. You need someone who's looking at all those different things. If they just simply say, this is like worst case, if they just say, talk to your CPA or we don't do tax planning, then you just know that's pretty simple. So in my mind, as you all know, I wrote the book, I Hate Taxes. I think taxes are the biggest expense in someone's retirement. And so that's one of the biggest pillars, biggest foundations we have here from our planning with our clients to make sure that they're paying the least amount of taxes. Because our 5-pillar approach, which consists of tax planning, investment planning, income planning, healthcare planning, and estate planning, most of those 5, pretty much all those 5, have taxes playing a part in each one. And that's why tax planning is so important. Like if your advisor's only doing investment planning, that's great, but are they doing it in a tax efficient way? Because if you have to pay more in taxes than what you need to, you may not be seeing as good of a return on your investments no matter how well they're doing. So that's why we always want to make sure we keep more and don't have Uncle Sam take as much of what we've worked hard for. So the next question I want to talk about is that I would recommend you ask is simply, how can you tell me if I will be subject to the Social Security tax torpedo? And, for many of the listeners, you may think, well, I don't even know what that is. Well, that's the goal, is you don't need to know what it is. Your advisor needs to know what it is. So they're being proactive for you and getting things done. So this is one I'll probably make a gamble and say over half, maybe more, of advisors don't even know what the Social Security tax torpedo is, which is a little scary to me because they're not planning for their clients if they're not getting this down. So I would tell you, if an advisor knows what the Social Security tax torpedo, that's a really good idea. If they know what that is. And so basically the idea of the Social Security tax torpedo is where your Social Security becomes fully taxable. And so most people don't understand of how Social Security is taxable. And it's actually based on your provisional income. So you take all these things, you add it up, and then that gives you a number to decide if your Social Security is taxable or not. The way the Social Security tax torpedo works is that if your income reaches a certain point, you could be paying a 40 to 50% total tax. So you'll pay your federal tax, you'll pay your Social Security tax, and all of that can actually combine for a certain period of time to be a 40 to 50% tax rate. Now, it wouldn't be 40 to 50% on everything, but for example, we've seen clients where if they were to take out an extra $10,000, they would be in that torpedo and they would be seeing half of that go to Uncle Sam, and they would only be able to keep half of that $10,000 that they took out. So they really thought they were taking out $10,000, but they only get $5,000. And so we really want to make sure people are aware of that torpedo, because that's going to hit most people that we work with who have been diligent savers. If they take withdrawals or they have these required minimum distributions at 73 or 75, that's going to be a significant amount to really bump their Social Security to be taxable. So I don't know about you, but I'd rather see people have more of their Social Security benefit in their pocket. And so that's the idea of the torpedo. So if the green light for them would be, they say, they discuss that provisional income I talked about, and, they're able to give you an estimate of whether your Social Security will be taxable and also how to avoid it. That's a big one. Are they planning to avoid it, or they just know what it is, or are they actually planning for it would be the next step there. And then a red light, which we say here, is what's Social Security tax torpedo? If they're saying that, then probably not a good thing. Probably not an advisor you'd want to trust all those years you've worked hard for. So the fifth question I have here is a good one, because many advisors don't talk about this, and the ones that do are typically doing a good job from what we see, is should I do a Roth conversion? And then your next question should be, how much? First question, should I do a Roth conversion? We see a lot of people who come to us and say, my advisor's never told me about a Roth conversion, or my advisor has told me I don't need to do a Roth conversion. And when I get that, when we hear those thoughts, it's a matter of like, are they running numbers? Are they exploring this further? Do they know about it? And so something we advise all of our clients is we need to decide if you need a Roth convert or not. Now, not all of our clients do Roth conversions, but I can tell you the majority of them do. And right now, during this current tax rate environment where we're seeing lower tax rates, Roth conversions have made a lot of sense for a lot of people. And the idea is if we can pay taxes lower now on our tax-deferred vehicles, our 401ks, our IRAs, and convert those over to a Roth, which grows tax-free, may set us up for a better position moving forward. So that's be something that I would highly encourage you of, but it's not enough to decide yes or no to that question. You really have to decide how much should I convert, which is a big question because there's so many different variables there. The Social Security torpedo we just talked about. You have to watch out for Medicare premiums of paying too much there. You have to worry about capital gains. You have to worry about phasing in and out of deductions and credits and net investment income. There's all these different things, these roadblocks, that you have to make sure you're choosing the right number of how much to convert. And we actually think it's more of a science. You got to run a lot of reports, calculators, software to determine what that is. So again, making sure your advisor team is doing that for you will help you put in the better spot. So green light for that question is simply they run numbers in your tax software, they look at what future RMDs will be, they address Social Security tax, they're aware of tax rates increasing in 2026, because all of those things are going to allow them to see should they do Roth conversions or not, and if so, how much. Red light is we are not a tax professional and you will need to see a CPA. Or they say Roth conversions, they recommend you do a Roth conversion without doing an analysis. Those would be things that I'd say no. Your financial planner should be doing tax planning. If they say they don't do that and they recommend you to your CPA, in my mind, that's a huge red flag. Make sure you're looking out for that. All right, question number 6 is what are your total fees? So this is a great question to ask that advisor, is understanding how much they're going to cost. Now, before I preface this question, it's not the most important one in my mind, because understand fees are mostly regulated in our industry. And so, to get the service level, you're going to have to pay something. And so the big question I want you to get out of this fee is making sure they're not trying to put in things that don't need to be there. And the second thing is make sure you're getting the true value for what you're paying for, right? We talk about the 5-pillar approach as being that standard of excellence that we would recommend people do for retirement. If they're only doing investment planning, you should not pay a full advisor fee, because you could go work with an advisor down the street, pay the same thing, and get 5 times the amount of planning done. You get 5 areas versus 1 area. So that would be my recommendation for that. So when it comes to how advisors are paid, just understand there's a few different types of fees. One is the management fee, and that is the fee that is paid to the advisor ongoing. That's the one you see debited out of your account each year. It's actually either done monthly or quarterly typically, and that's typically around 1 to 1.5%, depending on who you're working with there, and your asset size and all those factors. And then if you have more than about 3-5 million, you may start to see it go down. That's the idea. Internal expenses is another fee on top of the funds you're invested in. So we mostly see internal expenses becoming an issue when you're in mutual funds. That's where you could be paying anywhere from maybe 20 basis points, 0.2% is what that means, or maybe up to 1% or more on an additional fee to own that investment. So you may be paying a management fee of 1%, internal expense fee of 1%, you're at 2%. And so you want to be aware of, is that the right thing to do? So here at Peak Retirement, we don't use mutual funds. Not that we think they're bad investments. We just feel that our job is to manage our clients' investments. And so our investment team is the ones who are looking at that. And we're picking stocks and ETFs that are low cost investments to ultimately lower the costs, but we're still trying to have the active amount of trading that is involved in a mutual fund by trying to see what market trends are and to try to pay attention to all of that is something that we look at. So that's the internal expenses. The next one is platform fees. And so having an understanding of how much are you paying just to hold your assets somewhere. So I've seen advisors, they'll charge a management fee, they'll charge a platform fee to be able to have access to another, basically team to do all that for them. So you could be paying maybe 1% plus 0.5% plus internal expenses on top of that. You could be up there 2 to 3% pretty easily. So just be aware of that. And then also be aware of trading costs. Not something you typically have to look out for as much anymore, but you could have trading costs within your account. And if so, you want to watch out for churning and things like that that just aren't needed. So green light for that one is, are they able to clearly explain how much you will pay for every type of fee? And so also there's flat rate fees that advisors could charge. So they could charge you all of those fees I just mentioned. Plus they could say, oh, you got to pay me $3,000 a year too. I don't know if that's necessarily the best thing. Our clients, we only charge that asset under management fee. We don't charge any additional fees on top of that. I just feel that all of our planning should be condensed into one fee, not two. It's just my personal belief, and what I believe most people should be looking for. It's just the one fee, no need for two fees is what I'm a believer of. And then obviously a red flag here is they just do not give you a clear answer, or they only mention their management fee and they're not educating you on the other types of fee arrangements there. So hopefully that question will help you just educate you, but also know what to look for there. But again, if the advisor does great work, typically it's going to make sense to work with them. So just be aware of that. Even if they may charge a higher management fee, well, what is their services? And so it could still make sense as long as the other fees are in place. That could still be a valuable relationship, right? You get what you pay for sometimes, I guess, is the thought. And then the last question here that I wanted to address is, do you work as a team or individual? This is a personal opinion that I've had from experience. When I started Peak many years ago, it was just me. Now we've got an entire team to best serve our clients. And if you ask me, I'm going to tell you that our clients are way better served now than when it was just me. And the reason why is because it was just me, I couldn't do everything. It was one mind, and it was one person working for many people. Now we've got a team of people working for a group of people, and now we can leverage our resources and our minds of different areas of specialty to make sure we can best serve our clients. And so if you want to work with an individual, I think that's fine. I don't see anything wrong with it, but I just don't know if they're going to be able to deliver a higher level service for all the different areas of financial planning, right? We make sure we work with, for example, an estate planning attorney with our clients to make sure that we can leverage that expertise and have that, meet with the attorney and our advisors to make sure we've got everything in place. So I think that's very important. And so the green light for you here on this question is, we work as a team so that, our current clients can receive the proactive focus and expertise that their plans require. And that would be a perfect answer in my mind. A yellow light, like I just mentioned, is, they work as a solo shop, but maybe they've limited themselves to fewer than 100 clients. And if they lower themselves to lower than 100 clients, then I feel pretty confident that they're going to be able to deliver that great service to them. It is great to have a team for all to tie into everyone, but if they've really committed themselves to less than 100, they're going to really commit to the service level over time. And I would say that's pretty good. You just have to know you're not going to have access to other people, or what if that advisor passes away, and all those fun things. So just be aware of that. And then a red flag is simply, I work as an individual and I have 5,000 clients. That's probably not a good thing. They're probably not going to spend too much time with you ongoing. They're probably not going to have a buttoned up process to show you how to deliver that service. So anyways, those are the 7 questions that we would recommend you ask for. We've got a document with all those 7 questions. I was basically just reading off those questions and giving you our answers of what we would recommend for that. So if you like that document, just reach out to us. You can give us a call or text, or go to our website, and we'll make sure to send you that document so you can have more of an overview of what this looks like, and maybe help you better choose this advisor, this team to serve you further. So with that being said, hope you enjoyed the show today, and we will see you on the next one.
Since we do not know your specific situation, none of this information can serve as tax, legal, insurance, or financial advice, and may be outdated or inaccurate. The information comes from sources believed to be reliable but cannot be guaranteed. This content is prepared for educational purposes only. If you need advice, please contact a qualified CPA, attorney, insurance agent, financial advisor, or the appropriate professional for the subject you would like help with. Peak Retirement Planning, Inc. is an Ohio-based registered investment advisor and able to offer advisory services in Ohio and in other states where registered or exempt from registration.